Hello, everybody. Before we go to the actual audiobook, I'd like to explain a little bit about the real situation in accounting world. As I mentioned before, all accountants are required to use a computerized system to calculate all transactions in a company. It's like a specific software for accountants. For examples, Oracle NetSuite, SAP, SBO, Accurate, or QuickBooks. So these are the names of the accounting softwares. An accounting information system collects and processes transaction data and then disseminates the financial information to interested parties. Accounting information systems vary widely from one business to another. Various factors shape these systems: the nature of the business and the transactions in which it engages, the size of the firm, the volume of data to be handled, and the informational demands that management and others require. Companies are placing a renewed focus on their accounting system to ensure relevant and reliable information is reported in financial statements. A good accounting information system helps management answer such questions as how much and what kind of debt is outstanding? Were our sales higher this period than last? What assets do we have? What were our cash inflows and outflows? Did we make a profit last period? Are any of our product lines or divisions operating at a loss? Can we safely increase our dividends to stockholders? Is our rate of return on net assets increasing? Management can answer many other questions with the data provided by an efficient accounting system. A well-devised accounting information system benefits every type of company. Let's take a look on the basic terminology here. Financial accounting rests on a set of concepts for identifying, recording, classifying, and interpreting transactions and other events relating to enterprises. You therefore need to understand the basic terminology employed in collecting accounting data. The first one is event. Event is a happening of consequence. An event generally is the source or cause of changes in assets, liabilities, and equity. Events may be external or internal. Transaction is an external event involving a transfer or exchange between two or more entities. Account is a systematic arrangement that shows the effect of transactions and other events on a specific element or asset, liability, and so on. Companies keep a separate account for each asset, liability, revenue, and expense, and for capital or owner's equity. Real and nominal accounts. Real or permanent accounts are asset, liability, and equity accounts. They appear on the balance sheet. Nominal or temporary accounts are revenue, expense, and dividend accounts. Except for dividends, they appear on the income statement. Companies periodically close nominal accounts. They do not close real accounts. Ledger. Ledger is the book or computer printouts containing the accounts. A general ledger is a collection of all the asset, liability, owner's equity, revenue, and expense accounts. A subsidiary ledger contains the detail related to a given general ledger account. Journal is the book of original entry, where the company initially records transactions and selected other events. Various amounts are transferred from the book of original entry, the journal, to the ledger. Posting. Posting is the process of transferring the essential facts and figures from the book of original entry to the ledger accounts. Trial balance. Trial balance is the list of all open accounts in the ledger of their balances. The trial balance taken immediately after all adjustments have been posted is called an adjusted trial balance. A trial balance taken immediately after closing entries have been posted is called a post-closing or after-closing trial balance. Companies may prepare a trial balance at any time. Adjusting entries. Entries made at the end of an accounting period to bring all accounts up to date on an accrual basis so that the company can prepare correct financial statements. Financial statements are statements that reflect the collection, tabulation, and final summarization of the accounting data. Four statements are involved. The balance sheet, the first one, shows the financial condition of the enterprise at the end of a period. The income statement, the second one, measures the results of operations during the period. The third one statement of cash flows, reports the cash provided and used by operating, investing, and financing activities during the period. The fourth one is the statement of retained earnings, reconciles the balance of the retained earnings account from the beginning to the end of the period. Closing entries, the formal process by which the enterprise reduces all nominal accounts to zero and determines and transfers the net income or net loss to an owner's equity account, also known as closing the ledger, closing the books, or merely closing. So let's take a look on the debits and credits section. The terms debit and credit mean left and right, respectively. These terms do not mean increase or decrease, but instead describe where a company makes entries in the recording process. That is, when a company enters an amount on the left side of an account, it debits the account. When it makes an entry on the right side, it credits the account. When comparing the totals of the two sides, an account shows a debit balance if the total of the debit amounts exceeds the credits. An account shows a credit balance if the credit amounts exceed the debits. The positioning of debits on the left and credits on the right is simply an accounting custom. We could function just as well if we reversed the sides. However, the United States adopted the custom, now the rule, of having debits on the left side of an account and credits on the right side. Similar to the custom of driving on the right-hand side of the road. This rule applies to all accounts. The equality of debits and credits provides the basis for the double entry system of recording transactions, sometimes referred to as double entry bookkeeping. Under the universally used double entry accounting system, a company records the dual two-sided effect of each transaction in appropriate accounts. This system provides a logical method for recording transactions. It also offers a means of proving the accuracy of the recorded amounts. If a company records every transaction with equal debits and credits, then the sum of all the debits to the accounts must equal the sum of all the credits. This illustration that I present is the basic guidelines for an accounting system. Increases to all asset and expense accounts occur on the left or debit side and decreases on the right or credit side. Conversely, increases to all liability and revenue accounts occur on the right or credit side and decreases on the left or debit side. A company increases stockholders' equity accounts such as common stock and retained earnings on the credit side, but increases dividends on the debit side. So let's take a look on the basic equation. The basic equation is assets equals liabilities plus stockholders' equity. In a double entry system, for every debit, there must be a credit and vice versa. This leads us then to the basic equation in accounting. So this illustration expands this equation to show the accounts that make up stockholders' equity. The figure also shows the debit or credit rules and effects on each type of account. Study this diagram carefully. It will help you understand the fundamentals of the double entry system. Like the basic equation, the expanded basic equation must also balance, or total debits equal total credits. Thank you very much for listening to this lesson today. We can continue the lesson to the next video. Thank you very much for listening and watching this video. See you again very soon and have a great day. Thank you.